Australia's economic recovery continues to gather pace, but the unevenness and the extremes of these unique conditions are ever present. An update on our views for the outlook as we approach the new financial year. The latest GDP numbers showing our economy is well ahead of pre-pandemic levels, together with fresh record highs for stock markets, for property prices, for business confidence and the price of iron ore, all seems to point in one direction. But this market optimism is hard to reconcile with the reality of international borders remaining closed and Melbourne back in our fourth pandemic lockdown. Some sectors of the economy are booming while others are languishing, which does make the ongoing commitment of fiscal support from the federal budget and monetary policy from the RBA a comforting reminder that policy support should remain in place until well after the pandemic is behind us and borders are reopened. The GDP data showed that nationally, the economy grew 1.8% in the first quarter and has grown 8.5% in the last 9 months. So our economy is around 1% ahead of pre-pandemic levels, and it was encouraging to see that business investment and household consumption was driving the expansion. There was a smaller contribution from public spending, but the large pipeline of infrastructure projects ahead will complement this momentum in the private sector. And so our Australian economy now appears likely to grow over 5% in 2021. The unemployment rate should also keep improving this year, hopefully down to or even below 5% by year end. Although the next few months may see a pause in employment growth due to the Victorian lockdown and mismatches between labour demand and supply. As for 2022, the outlook is also promising, but will increasingly depend on when international borders are reopened. And the best indicator of that timeline is vaccination rates. This may be the one silver lining of the latest lockdown, a rise in vaccine queues and a fall in vaccine hesitancy. So further progress there will add to confidence about a more sustainable recovery, which will require Australia and our trading and tourism partners to approach herd immunity. What that will ultimately mean for inflation and for interest rates is another discussion. But higher interest rates, if they come in 2023, which appears the most likely timing, will be a good problem to have, assuming it's being driven by full employment. Our Reserve Bank are insistent that any jump in inflation will be short-lived. But there are signs overseas that global reflation may be setting in more quickly. So we'll keep an eye on what that means for the RBA and unconventional policy settings such as quantitative easing. The markets are taking an optimistic view on all of this. Property demand is showing no signs of abating, and stock markets continue to love the sound of 2 more years of 0% interest rates, with our ASX 200 index matching global indices at record highs. Inflation shocks ahead, or perhaps QE taper tantrums, may add volatility this year, but the sharp rise in job vacancies and business confidence seems to suggest, despite these extreme, unique conditions, that businesses are focusing on the post-pandemic economy and the opportunities that should bring. And that's the market update from Leveraged.